Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Oklo.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10K with VIP indicators. VIP Indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10 is not guaranteed. Use these tools for education and analysis only, manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
So a single ChatGPT prompt uses roughly 10 times the electricity of a standard Google search.
Yeah, which is kind of wild to think about.
It really is.
Yeah.
Now imagine multiplying that by 1 billion, then multiply it again by, the countless new generative AI models being trained at this very second.
Right, it's exponential.
Exactly.
Yeah.
So if you're listening to this and thinking, well, why wouldn't I just buy Microsoft or Nvidia and ride the AI wave safely? Here is why. We are running headfirst into a brutal, undeniable infrastructure bottleneck.
And the power grid just can't handle it.
Right. The AI revolution isn't going to be stopped by a lack of microchips or, a lack of coding talent. It is going to be stopped by a lack of electricity.
Absolutely.
So we are scouring the market for the company trying to fix that exact physical limit.
Yeah, it's the stark physical reality of our digital expansion.
Yeah.
These new hyperscale AI data centers, they require a level of continuous, ultra-dense, reliable power that our legacy grid simply was not built to handle.
No, not at all.
And while wind and solar are excellent for general grid supplementation, they're intermittent, right?
Mm-hmm.
You cannot have a $2 billion AI supercomputer cluster just power down because a storm passed over a solar farm.
Or the winds start blowing in the Midwest, yeah.
Exactly. They need clean baseload power running 24/7. So this is causing a massive collision between the AI boom and what we're now calling the nuclear renaissance.
Which brings us to Oklo.
Right, and that's why Oklo is such a fascinating target today. They aren't trying to power an entire city with a massive traditional concrete dome reactor. They are building advanced, highly specialized, smaller scale nuclear powerhouses.
Designed explicitly to plug directly into these power-hungry data centers.
You got it.
Which means we really need to rethink how we value a company like this. It requires stepping back from the usual metrics for a moment. All right, let's move into the wealth building context.
Let's do it.
Because looking at Oklo, this is not a traditional utility play. If you're building a retirement portfolio and you're looking for stable quarterly dividends from a company just managing power lines, this is definitely not that stock.
No, definitely not.
This requires a completely different perspective. I like to think of this as, well, funding the construction of the Hoover Dam before the concrete is even poured.
That's a great way to put it.
It requires a multi-year mindset, extreme patience, and an understanding of heavily front-loaded capital.
Yeah, that Hoover Dam analogy is exactly right. What
Yeah.
you are looking at here is a rare, pure-play, asymmetric bet on advanced clean energy.
Right.
And when we talk about an asymmetric bet in wealth building, we mean a scenario where the downside is strictly capped to your initial investment, but the upside potential, it isn't just a 10% annual return.
It's exponential.
Exponential, exactly, because they're defining an entirely new market sector. And Oklo isn't just a white paper concept, They actually have a massive commercial pipeline already lined up.
Yes, they do.
We're talking about 15.2 gigawatts aimed directly at data centers, defense contracts, and heavy industrial applications.
Let's put that 15.2 gigawatts into perspective for you. 15 gigawatts is enough to power roughly 11 million average homes. But here, that staggering amount of power isn't being trickled out across a suburban grid. It is highly concentrated, sold directly to the highest bidders in the tech space who are, frankly, desperate to secure clean energy to satisfy their own net zero climate pledges.
Exactly.
If their proprietary tech solves the uranium bottleneck to actually deliver that power, that fundamentally alters their financial risk profile. which naturally leads us to the numbers. Now let's look at the fundamentals.
Okay, let's get into it.
Because this is where the analytical risk-aware side of me starts sounding the alarm bells. We mentioned the Hoover Dam analogy, and the brutal reality of building a dam is that it costs an absolute fortune for years before it generates a single dollar of profit.
Oh,
Oklo is currently pre-revenue. They're wandering through what the energy industry notoriously calls the Valley of Death.
yes, the Valley of Death.
Right, that terrifying cash-burning gap between brilliant research and actual commercial deployment. If we look at the recent numbers, they reported a Q1 2026 earnings per share loss of negative 27 cents.
Yeah.
That actually missed estimates by 10 cents. And looking ahead, analysts project a full year EPS of negative 75 cents. Unsurprisingly, their free cash flow is deeply in the red right now.
Well, the caution is completely warranted. If you looked at those numbers for a standard tech startup, you'd run for the hills.
Absolutely.
But Oklo's fundamentals require a deep dive into the balance sheet, not just the income statement. Their balance sheet is uniquely fortified to survive this specific valley of death.
How so?
Well, they are sitting on approximately $2.5 billion in cash with zero debt.
Zero debt. That's huge.
None. That is an incredibly expansive runway. But the metric that absolutely jumps off the page to me is their current ratio, which measures a company's ability to pay its short-term obligations.
Right.
A ratio of 1.5 or 2 is usually considered healthy. Oklo's current ratio is an astronomical 49.08.
Wait, let me jump in there to visualize that for you. A current ratio of 49.08 is like having $4,900 sitting in your checking account for every $100 you owe on your credit card this month.
That's a perfect analogy.
It's not just safe. It's practically bulletproof in the near term. More than just financial armor, that cash pile is an offensive weapon.
Exactly.
It means they have the capital to absorb those heavy upfront costs without constantly diluting shareholders just to survive.
Precisely. They have roughly $400 million in annual capital expenditures. And people often ask, well, why does it cost so much?
Right.
It's not just concrete and steel. It's advanced specialized materials, top-tier nuclear engineering talent, and a massive legal and regulatory apparatus.
Which isn't cheap.
Not at all,
Right.
but they can cover that burn rate easily.
Right.
But the true fundamental story here, the reason they are valued so highly, despite being pre-revenue, is their competitive moat.
Okay, let's talk about that moat.
It's a dual advantage. First, they use a vertically integrated owner-operator model.
Yeah.
Many of their competitors just design reactors and try to license the blueprints for a one-time fee. Oklo retains full ownership of their Aurora powerhouses. They sell the actual power directly to the data centers under long-term agreements. That means recurring, predictable, highly lucrative revenue for decades once they are operational.
Right, but the second part of that moat is the fuel itself. And this is crucial because the global uranium supply chain is notoriously bottlenecked.
Very much so.
It relies heavily on a few international players, some of which are located in, let's say, geopolitically unstable regions. That is a massive risk for any traditional nuclear company. But Oklo does something different.
This is where the science translates directly into a massive business advantage. Oklo utilizes a proprietary fast fission technology that runs on what's called HAEU.
HAEU, okay.
Yeah, that stands for high assay low enriched uranium. But we probably need to explain how this actually works.
Yeah, let's break that down.
So traditional legacy reactors are wildly inefficient. They are like a car engine that only burns about 5% of the gas in the tank.
And the rest?
It just spits the rest out as highly dangerous radioactive waste. The world currently pays a fortune just to safely store that unused radioactive sludge. So Oklo's fast fission technology uses faster-moving neutrons to essentially chew through that leftover waste, extracting the remaining energy.
Wait, so they literally turn existing nuclear waste into fuel?
Exactly.
That is incredible. They are essentially creating a dual revenue stream. They get paid by the tech giants to generate clean power, and they simultaneously solve a massive global waste management problem.
Right, completely insulating themselves from those international uranium supply chain bottlenecks that terrify everyone else in the sector.
They take a liability and turn it into an asset. And the timeline for proving this technology at scale is, well, it's happening right now.
Yes, it is.
That brings us to the catalyst timeline.
Right, because in the short term, this stock trades almost entirely on narrative and technical milestones.
No.
We have May 12 earnings coming up.
Yeah.
Obviously, with no commercial revenue, nobody's expecting a surprise profit. The entire focus of that call will be on management commentary regarding their cash burn rate and any updates on commercial deployment timelines.
Okay, but there's a bigger date.
Oh, definitely. The real date circled in red on the calendar is July 4, 2026.
Independence Day.
Yes. And for Oklo, it could be a truly independent energy moment. This is a critical Department of Energy milestone, where Oklo is targeting the achievement of criticality at their Aurora and Groves projects.
Criticality, right.
For those unfamiliar, criticality isn't just flipping a switch. It is the exact moment a nuclear reactor sustains a controlled, self-sustaining chain reaction on its own.
Ultimate proof of concept.
Exactly. Success there completely validates the complex physics and the engineering of their design in a real-world setting, not just in a pristine computer simulation. And this is happening against an incredible macro tailwind. McKinsey is currently projecting $7 trillion in AI capital expenditures over the coming years. That staggering amount of money is physically forcing institutional capital into clean energy solutions like Oklo.
Wait, hold on. Let me push back here on the execution risk. Engineering on this scale, especially nuclear engineering, it almost never runs perfectly on time.
That's fair.
We've seen traditional nuclear plants get delayed by decades. What happens if that July 4th criticality milestone slips? What if the engineering team hits a snag and it gets pushed to September or, even December?
It's a valid question.
In a pre-revenue company, tight engineering timelines are a massive vulnerability. Every month of delay extends the cash burn and tests the fragile patience of the market.
It's an absolutely vital concern. The history of nuclear power is littered with budget overruns and blown deadlines. And a delay here would certainly impact the stock price in the short term.
Probably cause a significant pullback.
For sure. But again, it's exactly why that fortress balance sheet is the anchor of the bullish thesis. A 6-month delay is a nightmare for a company running on fumes. For Oklo, the capital is there to weather timeline adjustments without threatening the core solvency of the business.
Now let's pivot to the chart.
Okay, let's look at the technical.
Because the technicals here perfectly reflect that exact tension between massive upside potential and timeline anxiety. This stock has exhibited explosive volatility.
Oh, yeah.
It is a high beta growth name sitting at a beta of 1.1 cent. In plain English, a beta over 1 means it is significantly more volatile and reactive than the broader market.
Definitely.
Just look at the 52-week range. It has traded as low as $26.16 and as high as $193.84.
That is an incredibly wide spread.
It really is. It shows just how much optionality the market is trying to price in on any given day.
Well, the recent price action tells a compelling story of how the market is shifting its view. In April alone, the stock surged 46.2%.
What?
That aggressive move completely erased its early Q1 losses and pushed it back into positive territory for the year. Technically speaking, the stock is currently attempting to reclaim its 200-day moving average, which sits at $81.43.
After bouncing hard off its 50-day moving average of $60.27.
Exactly.
And as anyone who studies charts knows, reclaiming a 200-day moving average is a major psychological barrier. It often signals a fundamental shift from a short-term relief bounce to a sustained long-term bullish trend.
Right.
But with a massive 46% surge in a single month, you have to ask, is this just retail traders gambling on a hot AI narrative on social media?
That's what a lot of people assume, but the underlying volume and flow suggests something much deeper. This isn't just retail speculation.
Okay.
This gap up in price reflects a fundamental re-rating driven by institutional whales. The momentum is heavily correlated with two massive macro catalysts that institutions watch closely.
What are?
First, the White House recently launched a national initiative for American space nuclear power, a domain where Oklo's compact technology overlaps perfectly.
Interesting.
Second, they announced a major collaboration with Nvidia and Los Alamos National Laboratory to use AI to accelerate nuclear fuel validation. When massive institutions see the U.S. government and Nvidia moving in the same direction alongside a company, they allocate capital accordingly.
So what does market sentiment look like?
Well, there's a lot to unpack.
See, because there is a stark, almost confusing contrast between what the massive institutions are doing and what the company's own insiders are doing.
The insider selling.
Exactly. I always look at insider selling as a critical gauge of internal confidence. Recently, the CEO sold almost $10 million in shares, and the CFO sold over $800,000.
Yeah, that made headlines.
If you were listening to this and thinking, well, if this is the holy grail solution to the $7 trillion AI bottleneck, why are the top executives cashing out millions of dollars of stock right before these major milestones?
Right.
It's a very loud alarm bell.
It is a headline that definitely looks incredibly negative at first glance, and it scares a lot of investors. However, context is everything in market sentiment.
What's the context?
These sales were executed under prearranged Rule 10b5-1 plans. These are automated trading schedules set up far in advance, completely blind to current events, precisely to avoid any accusation of insider trading.
Ah, okay, so it's mostly for taxes or diversification.
Exactly. Furthermore, even after these scheduled sales, the insiders still retain an 18.9% ownership stake in the company. They still have massive skin in the game.
That's a good point.
But to your point about sentiment, you have to weigh that scheduled executives selling against the highly aggressive, discretionary buying coming from smart money.
Right, the whales.
State Street essentially quintupled their position, growing it by a staggering 454.5%. Vanguard increased its holdings aggressively by 33.4%, and Mirai Asset grew by 71.8%. That is institutional smart money front-running retail, not just a casual portfolio reallocation.
The analyst ratings are a bit more mixed, though, which reflects the divide. You have JP Morgan initiating coverage with a neutral rating and an $83 price target.
Yeah.
But then you have Tigris Financial coming in swinging with a buy rating and a $130 target. That $47 spread between those two targets entirely reflects the uncertainty of that valley of death we discussed earlier.
It does. JP Morgan is taking the classic show me the money approach, which is standard for a massive traditional bank looking at a pre-revenue company. They want to see signed checks.
Of course.
But the more aggressive targets are looking at a massive speculative catalyst currently swirling in the market. There are strong, credible rumors, noted by several analysts, that Oklo is targeting a 1.2 gigawatt campus for an undisclosed major data center client.
Undisclosed, huh?
Now let's connect the dots. Given Oklo's history, Sam Altman, the CEO of OpenAI, is a former chairman, and they have this deep ongoing partnership with Nvidia market chatter, strongly suggests this undisclosed client could be a hyperscaler like Microsoft, Meta, or OpenAI itself.
That would be massive.
If a firm, legally binding contract with a hyperscaler of that magnitude is confirmed, that is the ultimate re-rating catalyst that blows past JP Morgan's conservative target.
Now let's talk about the risks.
Because there are definitely risks.
We have to look closely at the bear case, and it starts with the sheer weight of the valuation. Even with the recent pullbacks from its all-time highs, Oklo is carrying a $12.66 billion market cap.
Yeah, that's heavy.
A $12 billion company with absolutely zero commercial revenue and a price-to-earnings ratio of negative 101.12. That means this stock is priced for perfection. Any stumble, any delay, and that valuation becomes a very heavy anchor dragging the stock down.
That is the defining risk. The valuation is entirely based on future cash flows, and realizing those flows depends 100% on flawless execution.
Right.
The single most pressing risk right now is the conversion of their non-binding master power agreements into firm, bankable contracts. As you mentioned with JP Morgan, Wall Street is waiting for concrete evidence of commercialization.
Because an agreement to potentially buy power in the future is very different from a legally binding contract.
Exactly. You need a real contract to take to a bank to secure debt financing for construction.
And beyond the commercial contracts, there is the regulatory gauntlet. The Nuclear Regulatory Commission, the NRC, is infamous for its glacial pace.
Oh, yes.
Their entire culture is built on safety, not speed. Getting final operating licenses is a binary, multi-year hurdle. If the NRC demands redesigns or, simply drags its feet on the paperwork because they've never permitted this specific fast fission technology before, Oklo's target deployment timeline of 2027 or 2028 could easily slip into the 2030s.
Regulatory risk is always the darkest shadow hanging over the nuclear industry. It has killed dozens of promising companies in the past.
Right.
However, there is a strong mitigation factor uniquely present here. The NRC has actually accelerated its review schedule for Oklo. They recently approved their principal design criteria.
Which is a big deal.
It's a massive regulatory green light on the core physics of their design. The U.S. government clearly recognizes that if America is going to lead the global AI revolution, the regulatory bodies have to facilitate, rather than hinder, the energy infrastructure to support it.
Makes sense.
And again, it comes back to that fortress balance sheet. The $2.5 billion in cash is the shock absorber that protects the company from near-term solvency risk if the NRC process takes longer than modeled.
So with everything on the table, what's the final verdict?
Based on the research of the convergence of these macro trends, Oklo earns a bullish score of 8 out of 10.
Okay.
The investment stance is that Oklo represents a rare, asymmetric opportunity positioned perfectly at the intersection of the AI supercycle and the advanced nuclear renaissance.
They have a lot going for them.
They do. They have the explicit validation of both the Department of Energy and Nvidia, a proprietary waste-to-fuel moat that solves the uranium bottleneck, and a pristine balance sheet to survive the development phase.
So what's the timeline for investors?
The target horizon here is a multi-year hold, looking out 3 to 5 years to capture the commercialization phase, with a very real near-term swing trade catalyst approaching with the July 4 criticality milestone. For an investor willing to embrace the inherent volatility of a pre-revenue builder, the risk-reward profile heavily favors the long side.
It is a profoundly compelling thesis, but I want to leave you with a final thought to ponder, something that builds on the science we've just unpacked. We talked about their fast fission technology literally chewing through nuclear waste to create fuel.
Right.
Consider the broader implications of that chemical process. What happens to Oklo's long-term valuation if they eventually become a net producer of highly valuable industrial isotopes for the medical imaging and industrial sectors around the rest of the world?
Wow.
Rather than just acting as a specialized tower company for AI data centers, the optionality there isn't just about electricity, it's staggering.
That's a fascinating point.
And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is Grow $100 to $10 K with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.